morning. Welcome to KAPP's virtual classroom. In today's costing class, we shall be discussing some principle related to decision making. When it comes to costing subject, when it comes to costing decisions, the decision making is very important aspect of it. From examination point of view, this chapter is very important. From practical point of view as well, this chapter holds lot of importance. Every business is about decision making. When we discuss what exactly is decision making, so decision making is a formal process which involves both quantitative as well as qualitative factors. So when a business takes care of both qualitative as well as quantitative factor and decide what is good for the business, this process is called decision making. Decision making involves certain steps. Step 1. A business identifies the option. What are the options which are available to the business? Step 2. We analyze all the options. When it comes to analysis of option, there are many measurements. It could be from technical point of view, it could be from costing point of view, it could be from economic point of view. So that's here we analyze the options available. Step 3. We need more information regarding those alternatives. So step 2, whatever alternative we have identified, in step 3, we have to collect more information about those alternatives so that our decision making will be more informed and relevant. Step 4, we identify the best alternative, which meets all the criteria what business has set for them. Once the option meets all the criteria, we select that alternative. And last step, but not the least, this step says continuous monitor your alternative. So decision making is a continuous process. Keep monitoring what kind of decision you have taken and are we going as per plan or not. This particular step is called decision making. Now theoretically we understand what is the decision making. Now let's discuss the costing point of view of decision making. The decision making, particularly in this context, is focused on the cost part. When we take decision, there are certain costs which are relevant to our decision, whereas there are certain costs which are not so relevant for our decision. So let's identify what are the costs which are relevant and what are the costs which are not so relevant for our decision making purpose. Let's identify the cost as relevant cost and non-relevant cost. As the name suggests, the relevant cost is a cost which is relevant for our decision making, which impacts our decision making, whereas non-relevant cost is a cost which is not important for our decision making and those costs has no importance or impact on our decision. We call them non-relevant costing. Now when we understand the classification called relevant cost and non-relevant cost, let's look more into these costs and understand when do we call a cost relevant for our decision making. It has to have certain characteristics. First, it has to be future cost. A cost which has already been incurred has no relevance on our decision making. That is why in order to call a cost relevant cost, it has to be future related cost, not past cost. So one of the characteristics is it has to be future cost. The next is variable cost. Goes without saying that most of the variable cost changes with the decision. So for example, right now my company is making 100 units and they want to increase it to 100,000 units. My variable cost will change accordingly. So variable cost generally are relevant cost unless specifically mentioned in the question that this variable cost do not change. Otherwise, in normal context, we understand that variable costs are relevant. The variable cost could also be called avoidable cost. Why do we call them avoidable cost? Because if we do not take decision, we can avoid those costs. That is why sometimes variable cost can also be called avoidable cost. The third characteristic, it has to be cash costs. Any cost which does not have cash impact is not relevant for our decision making. For example, depreciation, for example, amortization. These are the costs which are non-cash cost, and those non-cash cost has no relevance for our decision making. So in nutshell, it has to be future cost, it has to be variable cost, and it should involve cash outflow. One more factor which is very relevant for our decision making, it's called opportunity cost. Let's understand what is the meaning of opportunity cost. The opportunity cost is the cost of best alternative, the second best alternative which is available, or the alternative which is foregone. Let's take an example. I'm staying in a house. I can give this house on rent. There are tenants who are ready to take this house on rent. But as I'm myself staying in this house, I'm not giving my house on rent. So in this example, what is an opportunity cost? The rent which I could have got if I would have given it on rent. Another example could be your employer asks you to come on weekends. If you go on weekends, you will get some overtime. You choose not to go. So the opportunity cost is the extra amount or the overtime amount which you could have got from your employer, but as you did not go, you have lost that amount. We call that opportunity cost. Whenever we select one alternative, we leave another. So while taking decision, we have to consider the opportunity cost as well. That is very important for business. So let's take opportunity cost as relevant cost. So just to repeat once again, future cost, variable cost, cash cost and opportunity cost, all these costs are relevant for our decision making. Let's discuss what makes a cost non-relevant. The first, it has to be fixed cost. A cost which does not change with your decision, it's called fixed cost. A fixed cost is non-relevant cost for our decision making. Please understand that this decision making process is for short term. In long run, there is no cost which is fixed. Every cost changes. But in this context, we are talking about short term decision making. And in short term, our fixed costs are not relevant for our decision making. But let's take an exception to the rule. If the fixed cost is specific fixed cost, that is relevant cost. What is specific fixed cost? For example, the rent of office, a fixed cost. It is non-relevant for my decision making. But what if my warehouse can only accommodate 100 units? If I have decided to produce 500 units, I may have to take another warehouse on rent, and the rent of next warehouse is specific fixed cost. The specific fixed cost is linked to my decision. I can avoid it too. If I would not go for 500 units, I can still be okay with my existing warehouse. That is why specific fixed costs are relevant for our decision making. I hope we are clear so far. Let's move to next part. Sunk cost. A cost which has already been incurred in the past is called sunk cost. Sunk costs are not relevant for our decision making. As we discussed in relevant cost, it has to be future cost. Now some cost has already been incurred. A cost which has already been incurred has no relevance on my future decisions. Third, committed cost. Committed cost is a cost which has been committed. For example, I have already purchased a machinery from vendor. I did not make the payment. I thought I will be paying in a month's time. In this 1 month, I decided not to use this machinery for production. Doesn't matter. It's a committed cost. I have to still make the payment to the vendor, even if I'm not using this machinery for my production. That's called committed cost. It's as good as sunk cost. And next, non-cash cost. As we already discussed in our topic of relevant cost, that the cost needs to involve cash outflow. Any costs such as depreciation, amortization, these costs are non-cash costs because these do not involve any cash outflow. So broadly, the cost can be classified as relevant as well as non-relevant cost. These are the list of costs which are relevant and non-relevant. Please understand that while taking decision, we only consider relevant cost and we ignore all kind of non-relevant cost. I would suggest that candidate need to have broad understanding of cost which are relevant, cost which are not relevant, so that you can identify those non-relevant costs and can ignore for your decision making. So that is broadly about relevant cost as well as non-relevant cost. Now when we understand the classification of relevant cost as well as non-relevant cost, now it's time to discuss what is the relevant cost for material, labor and overhead respectively. So let's start with materials relevant cost. One, that is material cost. Now when do we classify the cost as relevant and when do we classify as non-relevant? Let me give you two situations. Either the material is in stock or material is out of stock. There can be two situations for a business, that a company which has accepted new production order, either the material is there in their warehouse or material is not there in their warehouse. So when we say in stock, the material is already there. Material is out of stock, that we do not have that raw material right now which is required for the new production. Let's discuss this option first. The material is out of stock. That means, what do we need to do? We shall be going out in the market and buying it. So the relevant cost in this case is the current purchase price. This can also be called current replacement cost. The replacement cost is a cost which you incur to replace a material. Anything which is out of stock needs to be replenished. So in this case, as we do not have that material in stock, whatever day you will be going out in the market, that will become your relevant cost. We call that current purchase price or current replacement price as relevant. Are we clear? Now let's talk about the next situation. The material is already in stock. There can be two scenarios here. One, the material is in continuous use and another could be non-regular use. So the first situation, that you are doing the production right now, the material which you are using for the current production can also be used for the new production. So that's where we can say the material is already in stock. That particular material may have two situations. One, it's regularly being used. Secondly, it was purchased some time back and still there in the warehouse. Nobody uses it now, not in regular use. So if it's a first situation, that material is regularly in use, in that case, the things will be finished and it needs to be replenished again. So it's as good as this case. In this scenario, the relevant cost will be current purchase price or current replacement cost. Because when something is in regular use, it will be finished. When it will be finished, it needs to be replenished. Next situation. The goods are not in regular use. That means the goods were purchased. Now it's already there in warehouse. Nobody uses it. In normal scenario, what would you do with a material which was purchased and not is being used now? We do scrap it. So in this case, the scrap value is an opportunity cost. You would have sold this good because nobody is using it. But now instead of selling it, you are using it for the current production or the new decision what you have taken. And that's where the relevant cost here will become opportunity cost. And opportunity cost in this scenario, it is scrap value. So let me quickly run you through this diagram once again. What is the relevant cost for material? There can be two situations. The material is already in stock, the material is out of stock. If material is out of stock, it needs to be purchased. If it needs to be purchased, the relevant cost will be current purchase price or current replacement price. The next situation, the goods are already there in stock. Again, there can be two situations. The goods are in regular use, the goods are not in regular use. If the goods are in regular use, the current purchase price will become relevant cost because all the productions are using same raw material. It will be finished, it needs to be replenished. That's why the current purchase price is relevant cost. The next situation, the goods are not in regular use. It's just lying in the warehouse. So in normal scenario, we would have scrapped it. And now as you are using for current production, you are not scrapping it. So opportunity cost will be taken into consideration. In this case, the opportunity cost is scrap value. So I hope we are clear with this diagram as to when do we call material as relevant. Now let me just give you quick points here. In examination, you may get a lot of text in this kind of question. Not every single text which is given or not every single number which is given in the question is relevant. So let's try to sort it out first. Whenever question gives you any figure that a material was purchased 2 years back at this price, ignore it. It's historical cost, sunk cost. Whenever you get such question, few things should come in your mind. One, is the good there in the warehouse or it's not in the warehouse? If it is there in the warehouse, what is the situation? Is it being used or is it not being used? Your question will specifically give you these terms, whether it's regular or whether it's non-regular. If it is not regular, then opportunity cost will be considered. If it is already in regular use, whatever is the current purchase price is given, please pick up that. So my suggestion is that after looking at this diagram, please practice the questions so that you will understand how to implement this. If you have any question, you can write back to us at info@onlineglobalcareer.com for any kind of query related to practical solution of the problem. Now, as we understand the relevant cost for material, it's time for us to understand what is the relevant cost for labor. How do we decide whether this labor cost is relevant for our decision making or it's not relevant for our decision making? So now let's discuss the labor part. The way we understood the material cost, it's time for us to understand the labor's cost as well. Either labor has the spare capacity or they do not have spare capacity. When we say spare capacity, that means suppose labor is getting paid for 9 hours a day and all 9 hours are occupied. In this case, we can say that labor does not have spare capacity. Vice versa, we can say labor, they do have spare capacity. So when we say yes, that means labor has spare capacity. When we say no, we say labor does not have spare capacity. Suppose business wants to go for further manufacturing of something and that's where they require labor. Now, labor does not have spare capacity. What will be the alternative? Either the business will go for hiring of new labor, or the business will be going with the existing labor for new production as well. If that's the scenario where company is not hiring new, what will happen? There's an opportunity cost which will come into picture. The opportunity cost here is lost contribution. Let me clarify, what does it mean? Let me give a situation. My labor is already working for 9 hours a day. They are already working on product A. I want them to work on new product X now. In this scenario, my labor will leave the work of A in between and then only can come to product X if I'm using the same labor, the existing labor. In this case, my product A will get suffered. So the lost contribution of product A is an opportunity cost which needs to be considered. So I hope we are clear on this part. If labor does not have spare capacity, either we go and hire new or we consider the opportunity cost, which is the lost contribution of existing product. Let's say, what if the labor, they do have spare capacity? The relevant cost in this case is nil unless company is paying overtime. If company gives specific overtime to the labor for new product, the overtime will be considered relevant cost. If company is not paying anything addition to what they are paying right now, the relevant cost is gonna be nil. So let's a quick recap. Labor, either they have spare capacity or they do not have spare capacity. When they do have spare capacity, relevant cost is nil. If company is paying overtime or something in addition to what they were giving before, that will be considered as relevant cost. If the company is not having spare capacity with labor, either they will hire or they will use existing labor. If they hire new, the cost of hiring will be considered, and if they are not hiring, then opportunity cost will be considered. So that's how we consider the relevant cost for labor. Now we have discussed relevant cost for material, we have discussed relevant cost for labor. When it comes to relevant cost for overhead, that's already been discussed, that all variable costs are relevant, all fixed costs are non-relevant, unless it is specific fixed cost which is considered as relevant. So we shall be going with the same principle what we have discussed in the beginning, relevant versus non-relevant. Now broadly we understand what is the relevant cost for material, labor and overhead respectively. Now let's make a formula for relevant cost. The relevant cost is equal to variable cost plus opportunity cost if any. I repeat, the relevant cost is equal to variable cost plus opportunity cost. Mostly the students make some silly mistake in examination. They do consider opportunity cost, but they generally forget to consider variable cost. Not done. The relevant cost is a combination of both. So basically you have to consider all the relevant cost, which could be primarily variable cost, plus if there will be any opportunity cost, that will be considered. So altogether relevant cost needs to consider both variable as well as opportunity cost. In some question, if opportunity cost are not given, then only variable cost will be considered as relevant cost. So I hope by now we are absolutely clear about how to classify the cost between relevant and non-relevant. Now, next steps 2, let's understand how business take decision when there is something in short supply. After understanding the concept of relevant cost, now it's time for us to understand how business takes decision when the resources are in short supply. As a business, there can be many situations where business may have certain resources which are not unlimited. It could be labor, it could be availability of raw material, it could be demand in the market. So all those factors could be around in the business and business needs to still take decision. So in this part, we will be understanding how business optimize the utilization of resources and how can they maximize their contribution when they have certain things which are short in supply. We can also call this limited factor decision. So whenever business has certain factors which are limited, how do they take decision? I will give an example. Let's solve a question together and understand how business takes decision. Let's say there are three products X, Y and Z respectively. The selling price per unit for X is 10, for Y is 15, for Z it is 20. The variable cost per unit are respectively as 8, 5 and 18. In this case, our contribution per unit is going to be 2, 10 and 2 respectively. Now we understand there are three types of products and the contribution per unit is coming as 2, 10 and 2 respectively. How will business take decision if they have something in short supply? Let's take example. In this case, business has labor hour which are maximum 20,000 available. So the maximum supply of labor hour in this case is 20,000. A business cannot exceed the labor hour more than 20,000. How will business take decision? Most of the people will decide basis the contribution and they would say as Y is giving the highest contribution, we should select Y. But this is not the right place to take decision. Let me convert this contribution per unit into contribution per labor hour. Reason being my labor hour is in short supply. So let's say how many labor hours are required to produce one unit. Let's take example. For X it is 2 hours per unit. For Y it is 5 hours per unit and for Z it is 1.5 hours per unit. So in this example, we are converting our contribution per unit to contribution per labor hour. Reason being our labor are in short supply in this scenario. So in this case, contribution per labor hour for X is going to be 1, for Y it's going to be 2 and for Z it's going to be 1.3. Now that's the right place to decide. Let's prioritize it. 1, 2 and 3. That means Y seems to be most profitable product for the business. Then comes Z and then comes X. So when it comes to allocation of resources, the first thing company is going to do, they're going to allocate all the resources to Y and then they'll be converting it to Z and then finally to X. The demand for product in this case is 1000 unit, 2000 unit and 8000 unit respectively. So in this particular part, we understood how business prioritize it. So when your examination question says, calculate optimum mix, the optimum mix is Y, Z and X. If question says, how much is the total contribution or the maximum contribution business can get? For that, we have to take further steps and convert that total contribution. Now let's see. That's the maximum demand for Y. So Let's change the format a bit here. My product Y is first priority, then Z, and then X. Let me put units here. First thing we're gonna make is 2000 unit for Y. How many hours do we require to make Y's 2000 units? If one unit requires 5 hours, that means 2000 unit will be requiring 10,000 units. 10,000 hours. Come to Z. We need 8,000 units of Z. And that's where my total requirement for hours for Z is how much? 1.5 multiplied by 8,000, that is 12,000. But my total availability is only 20,000 hours. That means maximum we can devote 10,000 hours here, and we cannot produce 8,000 units. We can only produce how many units? 10,000 divided by 1.5. That's going to be my maximum units which we can produce. We do not have anything for X because we have already optimized the solution. So the way company is going to devote their resources, first they will complete the resource to the Y. The remaining hours will be given to Z, whatever is availability, and in this case, nothing is available for X. If you add all this, it will become contribution for this business, which is the best possible contribution available. In some scenario, may possible that company might not have anything for the product X. In this case, what will business do? Either they can outsource the business to someone else, or in longer run, if business think they cannot continue with this product, they may wind up the operation of product X. But that's company's perspective altogether. In short term, it's too early to take a decision by business to close down any operations. So higher chances a business would outsource the production of X and some part of Z, as Z is not able to get complete resources. They require 12,000 hours, but only availability is 10,000 hours. So remaining 2,000 hours can be outsourced, and so is the business of X. This is how we take decision when it comes to limited factor, and that's what we call limited factor decision. The do's and don'ts for this kind of questions. 1. Try to understand what is the factor which is in limited supply. Convert the contribution per unit to that particular resource which is in short supply. And then try to prioritize which product gives highest contribution per limited resource. Allocate all the resources to the first product which gives the highest contribution, then comes second, third, and so on. If company is not left with any resources for the product which does not give higher contribution, business might think to outsource it. That's all about limited factor decisions. Now, as we understood how to take limited factor decision and how to prioritize the resources, some more facts related to decision making. How would a company decide whether to shut down the operations or should they continue with the operations? Normally, if you ask any accounting student, they would just focus on the cost part and they would say if the contribution is negative or the contribution is least, discontinue. Practically, it's not possible. One, there are a lot of shutdown costs involved. Sometimes your shutdown cost must be much higher than your continuous operational cost. So a business needs to see how much is the advantage out of shutdown. There are a lot of qualitative factors also involved when it comes to shutdown. So let's take about the cost first. When a business shut down, they need to sell their machinery. They may need to think about the labor which needs to be given the another job or some kind of compensation which needs to be paid to the labor. There can be lot of regulatory cost. For example, in India, when a company winds up its operation or they close the company, they have to keep filing the returns for certain years. So that cost is also involved. Now you have a premises on rent. You're closing down the operation. So what will happen with the premise? So all those costs needs to be considered while you take shutdown decision. Then see how much is the advantage you are getting out of shutdown. What if you will continue the operation? How much is the loss and how much is the cost for shutdown? If your shutdown cost is lesser than what you're spending right now, it makes sense. Also look at the qualitative factor. What will be your impact on the brand image? Sometime when business closes down certain operation, they may have a negative publicity in the market. People might perceive as that business is closing altogether. So those factor needs to be considered too. Now what will happen to the labor who are working? What will be the impact on them? That needs to be considered. So shutdown operation needs to be considered from all angles. So broadly in decision making, we understood how to classify the cost between relevant and non-relevant. Then we understood what is the relevant cost of material, labor and overhead respectively. Then we discussed the limited factor decision and shutdown decision. And now, just to close down this topic, I suggest then when we do decision making, look at the question from all angles, be it your practical life decision or be your examination question. Do not just focus on one part, that's numbers. A business needs to take a lot of angles into consideration while deciding on something. When it comes to case study question also, that is being expected from you that you look at this question from all angles. What will be the impact on people? What will be the impact on brand image? What will be the financial implication of it? And then only you take decision. In our limited factor decision, we considered approach which is the highest contribution selection. So we selected a product which gives us the highest contribution. What will happen if a business has two constraints at same time? In this example, we considered that labor hour is in short supply. But practically there may be a lot of situations where labor hour may not be available. At the same time, demand will not be there in the market or any constraint which are more than one. In those scenarios, we cannot use this method. Then we'll be going for an arithmetical or mathematical solution called linear programming. So linear programming is a solution for those decision making problems where there are more than one product constraints involved. In our next session, we'll be talking about the linear programming concept. Till then, stay tuned, study well. Thank you so much.